Yes, today we are going to see variance. Variance, I mean overhead, variance. So we are going to see overhead variance. So what is meant by overhead? Overheads are indirect costs which are involved indirectly in the production process. Example, rent, depreciation of plant, and machinery, factory, supervisors' salary, and so on. So here we are concerning overheads are indirect costs involved which are involved indirectly in the production process. Example are rent, depreciation of plant and machinery, factory supervisor salary, and so on. So this is the meanings of overhead. Overheads are fixed costs which are involved indirectly in the production process. Now, a company wants to produce product A. To produce product A, the company will rent a building for 1 year, $100,000 for 1 year. So we need to rent a building, the rent per annum $100,000. So to produce product A, we need direct materials, $30. We need direct labor, $20. We need to pay for electricity, $10. So in all, we have to pay $60. So this is for direct material, direct labor, electricity. This is for 1 unit of product A, the cost of 1 unit to produce product A. So we have to add rent which is an overhead. So we have to add overhead in order to get the total cost. So how many overheads we are going to add? For 1 unit, we cannot add 100,000. So we have to add for 1 unit. So how do we calculate overhead for 1 unit? Let's say we are here in January. In January, we are producing 1 unit, and then the accounting period will end December. So in 1 year, we are producing 1 unit of product A, then we will be producing 1 unit of product A again and again and so on until December. So in December, we will know how many units we can produce. But for the time being, what we will do a budget, an estimate. So let's say the company will produce 5,000 units. Now it is understood that the overhead per unit will be 100,000 over 5,000 units. Then this will give us $20. So overhead per unit will be $20. This one will give you 80 total cost. Then we can calculate the selling price. So this is based on the estimated units of 5,000 units. So it means that when we are selling 1 unit of product A, so we have to save $20 to pay for rent. So 1 unit again, when we are selling, every time we are selling 1 unit, we have to save $20 to pay for rent. So at the end of the year, so we have been able to produce only 4,000 units. We are expected to produce 5,000 units, but we produce only 4,000 units because it is at the end of the year that we will know how many units we have been able to produce. So we have been able to produce 4,000 units. So it means that how many rents we have to pay. If we get $20 per unit, then 5,000 units, then we will get 100,000 to pay for rent. Every 1 unit we are selling, we are getting $20 to pay for rent. But this time, we have produced only 4,000 units. So it means that 4,000 units times $20 for rent, this will give us $80,000. So we have been able to recover only $80,000 instead of we have been able to recover only $80,000. $80,000. So $80,000, 4,000 units times $20. So we have been able to recover only $80,000. So we have not been able to recover. So we have to pay rent 100,000. So we have been able to recover only 80,000. So 20,000 is a loss. 20,000 have not been able to recover. So we are going to discuss this the overhead which have not been able to recover because we have not been able to produce 5,000 units, the budgeted units. So in this case, there will be a difference in terms of overhead. Now, let's say this is an example. So we are more concerned about overheads. We are not concerned about variable costs. Variable costs will vary directly with the units produced. Now, let's see this example. Budgeted units. So budgeted units, we are expecting to produce 5,000 units. Actual units, we have been able to produce only 4,000 units. Budgeted overhead, we expect budgeted overhead, that is rent, budgeted overhead 100,000 for rent. Actual overhead, we expect to pay 100,000, but this time in December we have to pay rent 150,000. So rent has increased by 50,000. So this one we have to discuss. Budgeted units, we want to produce 5,000 units, but we have been able to produce only 4,000 units. Budgeted overhead, budgeted rent, we are expecting to pay rent 100,000, but we have the rent has been increased to 150,000. So this one we can represent it in a statement in order to be more explicit. Now, let's see this statement. How can we do it? Budgeted, let's see, this one, budgeted, we can do it in a statement, budgeted overhead. So what is a budgeted overhead? 100,000. So what is a budgeted units? Budgeted units, 5,000. So in this case, the recovery rate will be 1,000 divided by 5,000 units. This will give us a recovery rate of $20. Now, a recovery rate of $20. And here, actual units. How much the actual units are? 4,000. And the recovery rate 20, the recovery rate 20. So in this case, recovered overhead 80,000. Recovered overhead 80,000. So what is actual overhead? Actual overheads 150,000. So here we go. This is the way we can copy budgeted overhead 100,000, budgeted units 5,000. So the recovery rate will be $20. Actual units 4,000. Recovery rate 20. We can recover 20 for each unit. Then we will recover $80,000. What is actual overhead? 150,000. So this one, the cost is actual overhead, actual cost 150,000. So we covered only 80,000. This one will give us fixed overhead cost variance. So in this case, the fixed overhead cost variance will be 70,000. We have to pay 150,000, but we recovered only 80,000. So in this case, there is a loss of 70,000. Budgeted overhead 100,000 and actual overhead 150. This is a fixed overhead expenditure variance. Fixed overhead expenditure variance, this one 50,000. So we pay more. We expect to pay right 100,000. So we pay 150,000. And here, budgeted units, we expect to produce 5,000 units, but we produce 4,000 units. This will give us fixed overhead volume variance. So we are going to do it mathematically now, okay, in terms of formula, where we are. So let's see the first one. Fixed overhead cost variance is equal to recovered overhead minus actual overhead. So what is a recovered overhead? 80,000. What is actual overhead? 150,000. So we have been able to recover only 80,000. So this will be adverse. Fixed overhead cost variance. Now we are going to see the second one. Fixed overhead expenditure variance. Fixed overhead expenditure variance is equal to budgeted overhead minus actual overhead. So budgeted overhead 100,000, actual overhead 150,000. So this will give us 50,000 adverse. This is a way to calculate budgeted fixed overhead expenditure variance. And now we see the last one for overhead. This one. Fixed overhead volume variance is equal to standard units minus actual units times recovery rate. So standard units 5,000, actual units 4,000, and recovery rate 20. So this will give us $20,000 adverse. We expect to produce 5,000 units, but we produce only 4,000 units. So this will become adverse 20,000. So we can do the test. Fixed overhead cost variance is equal to fixed overhead expenditure variance plus expenditure plus volume, fixed overhead volume variance. So we place what is a fixed overhead expenditure variance, and fixed overhead volume variance 20,000 adverse, and fixed overhead expenditure variance 50,000 adverse. This will give us 70,000 adverse. So here we are, so far concerning overhead variance. Thank you very much.